Welcome back. Investors have watched with some hope markets rise since early April in a fairly elevated way. Our next guest believes the peak of uncertainty, market uncertainty, could now be over. Let's bring in a veteran market watcher. Pierre Ouimet, head of investment strategy at UBS Canada, joins us right now. Pierre, thanks a lot for joining us. You do indeed say in some recent commentary to readers of your work, while volatility is likely to remain elevated, we believe we are past peak uncertainty. What does that mean, and what does it mean particularly in the context of the sharp rally we've had in North American stocks since the first week of April?
Yeah, well, good day, Paul. Nice being with you. But yeah, it's I think when the U.S. and the U.S. administration went to the moratorium, I think that ruled out kind of the chaos scenario that some people have been factoring in. And pronouncements out of the U.S. administration of late have been a lot more accommodating on tariffs than they have been in the past. I mean, Canada, China, and I think there's a lot more reasonableness in terms of addressing the particular issues. And I think the administration is realizing to what extent they're running a huge economic risk right now with these tariffs, which are vastly unpopular as well. So it's a combination of two things, really: the economic data, but also the precipitous drop in approval rating of the current administration, particularly Mr. Trump, and I think he's sensitive to that.
You say you're neutral on global equities, but hold an attractive view on U.S. equities. That's interesting. That sounds like a contrarian view. I get a lot of people on this channel telling me the opposite, that they have moved to some degree out of U.S. stocks and have a greater weighting in non-U.S. stocks.
Yeah, it appears at face value to be somewhat controversial, but we always kind of run our equity strategies somewhat barbelled, where we emphasize high quality, dividend, income, and but we're not afraid of looking at growth at a reasonable price. And given the current sell-off or the recent sell-off in some of these tech stocks in the U.S., we've gone neutral to U.S. equities. Now we've kind of turned that back up to more positive on U.S. equities. And I mean, you look at the results this week. I mean, across the board, they're not as bad as some people expected. In some cases, they're quite surprisingly strong. So if you want growth, I mean, U.S. large cap growth is technology in particular is the place to be. So it's kind of unavoidable within the scheme of things. But, you know, portfolio is made up of many things. It's not only tech, but it's could be a whole host of other things as well. But even in tough markets, there are always some good opportunities out there.
You outline three macroeconomic scenarios, and you have a base case, which you think is the most likely, and that is an economic slowdown induced by tariffs. It's not a hard landing, and it's not a positive surprise where everybody gets some good news and the economy chugs along. What happens to equities in a tariff-led slowdown?
Well, the market has rallied over the last few weeks, actually, and we're not far from what our kind of updated target of 5,800 on the S&P 500. So it's going to be tough for this market to go above 6,000, quite honestly. You know, and the fact that probably the main factor is earnings revisions. We're seeing B of A, Merrill Lynch, the earnings revision ratio has gone down substantially. And the consensus for earnings this year has gone down as well, and could continue to erode in the weeks to come as well. So I think interest rates are a prime factor for equity markets, but earnings count a lot, and those are the two main factors that drive equities. So with revisions to the downside and interest rates really not going down much more than a lot of people anticipated, that probably means that equity markets are probably range bound from here. So, but we've avoided the worst case scenario. I think in our perception is eventually cooler heads will prevail, and it's you can't go into a brave world where there's 10 to 15% across the board tariffs. Even that, which is our base case scenario, I would hope that would come down substantially, and we're not probably going to go to the pre-tariff era of 2.5% U.S. Average tariffs, but if we can drop below 10% and it'd be more specific to certain industries and not as broadly brushed as some of the what was announced on April 2nd was obviously a total disaster. So we're moving away from that gradually and slowly. So it leaves us some room to be a little bit more constructive.
Let's finish
cautious.
Go ahead, finish.
Yeah, we should still be cautious. I mean, it doesn't mean we're out of the woods yet. I mean, there's still a lot of uncertainty, and the tariffs are still there. It's that hasn't gone away, and there's always the risk that if someone doesn't act accordingly, that there could be further tariffs and further consequences to that. So it's not gone away. The uncertainty is still there. There's a little bit less of it, but not dissipated completely.
Okay. I was going to ask her for your view of commodities, but we are out of time. So come back soon and we'll talk commodity markets with Pierre Ouimet, Head of Investment Strategy at UBS Canada.